simple candlestick patterns. First of all, candlestick signals provide a major benefit because it gives us that high probability entry strategies. And also these provide the expectations about what should be happening along with the confirmation of the signal. Again, this is not an exhaustive list that you see here, but these are some to get you moving forward with your trading, and you can apply simple rules to drive profits. Again, you don't need a ton of trading strategies, but just follow a few and work on them. So if you follow these along, this should be more than sufficient. Keep in mind, I will also show you later on how to identify stocks that exhibit these patterns in various scans, and also talk about just one pattern that I typically trade, which will incorporate some of the other strategies that we've learned in this course earlier by layering in some of the indicators and some of the other strategies. But anyways, that is once we get through this theory now. So let's straight away get to this theory. Keep in mind this might be daunting in the beginning, but once you do this day in and day out, you will recognize these candles and this will become second nature. Again, like I said, I'm only covering a few major candlestick signals you need to know, and you will see this again and again on charts. So recognize them, understand them, learn them, and use them correctly. This is nothing but common sense built into graphic depiction. Again, it's not a difficult process. Simple visual patterns like these have produced high profit results for centuries and centuries for Japanese rice traders. So without wasting much time, let's get into the signals. So the first signal here you have is the doji. The doji signal is composed of one candle. Doji means indecision. It is formed when they open and close at the same price or the same level or very close to the same level in any specific time frame that you're looking at. So typically the candlestick shape that you see here is like a cross formation, right? So the horizontal line represents the open and close are occurring at the same level, and the vertical line shows the trading range during that time frame. So if you see a doji in an overbought or oversold condition, there is an extremely high probability of a reversal happening when it comes to the trend. So again, overbought or oversold conditions can be defined using the indicators that we've covered earlier in the course, such as RSI. So when a doji appears, it is demonstrating that there is indecision now occurring at an extreme portion of a trend. So this indecision can also be portrayed in a few variations of the doji. So doji opens and closes at the same level. That's the neutral one. Then there is a long-legged doji. So this is if a stock has a huge price move during the day but still closes at the open. This means greater indecision. So typically they say that if the stock opens lower the next day, you just get out of the trade. Next is the gravestone doji. So this is formed when the open and the close occur at the low end of the trading range. So the price opens at the low of the day and then it rallies from there, but it simply cannot keep up. By close, the price is beaten back down to the opening price. Now the gravestone doji, if this occurs at the top of the trend, this becomes a specific version of the shooting star. And at the bottom of the trend, it is a variation of the inverted hammer. Again, I will be covering shooting star in the next video, but for now, just understand that it's a variation there if it happens at the top of the trend. Now, dragonfly doji, the shape is similar to a dragonfly. It opens, trades lower, and closes at the top at the open. So gravestone doji is just the opposite of dragonfly doji. Now, if you see a doji anywhere at the top of a chart, the recommendation is to take profits. So again, the stock also has to be in an overbought condition, and the candle that follows the doji should be a down candle. So that's one rule that you can follow. So doji is happening at the top, and if the stock gaps down, just sell it, and assuming that the stock is in an overbought condition. So whereas if you see a doji at the bottom of the trend, You just need to see bullish confirmation to get into the trade. And keep in mind that the stock also has to be in an oversold condition. And if the stock opens positive after the doji, you can just go long. And also you can use the other EMA 8 strategy which we talked about earlier. You can also incorporate that into this strategy. So if the stock opens above the T line, then you can go long after the doji. Next is the hammer signal. So this shows a potential change of sentiment again. Only one rule you need to know here is that it's 2. What do you mean by 2 is the tail is at least 2 times greater than the body. So the body could be white or dark. I haven't shown the dark here. So again, if I say white or dark, it's green or red, right? So green has more bullish implications than a red body. So after a downtrend, all you need to do is you need to wait for a bullish confirmation to go long. That is, a positive day is required the following day after this hammer signal. Now the hanging man is just the opposite of the hammer. This is more like a precursor for a bearish move. So as you can see, the hanging man is also comprised of one candle. Again, it's easily identified by the presence of a small body with a shadow at least 2 times greater than the body. So with the hanging man, this is found at the top of an uptrend. So the color of the body is not important, but typically a black, which is also a red body, should have slightly more bearish implications. So again, the following day, the stock needs to confirm the hanging man signal with a black candle or a down candle or a red candle, or better yet, a gap down with a lower close. Let's talk about shooting star, inverted hammer, and bullish engulfing signals here. For now, shooting star and inverted hammer, I have the same candlestick here for both those. But again, where these two differ is where this signal happens. So first of all, you can easily identify the shooting star or the inverted hammer by the presence of a small body with a shadow at least 2 times greater than the body. Now, with a shooting star, this signal is typically found at the top of an uptrend. So essentially what this signal is telling me is that stock moved higher, but then it couldn't close higher. Sellers are taking control and then they push the prices lower. Well, in this case, ideally I'd like to see a black candle or a red candle to show that it's having a slightly more bearish implication. So that's why the color of the body is very important for the shooting star. So typically at the end of the uptrend, if the next trading day after this signal, you should get a confirmation with a black candle or a red candle, that is a down candle, or better yet, a gap down with a lower close. That will just reinforce that selling is just going on. Now an inverted hammer, on the other hand, is actually the same shape, but this is found at the bottom of a downtrend. Now this shows evidence that the bulls are stepping in, but the selling is still going on, as evidenced by the way in which this candle plays out. Now in this case, for the inverted hammer to be bullish, the color of the candle, the small body has to be white, which is nothing but green. So that way it will have more bullish implications and indications than a black body or a red body. So also keep in mind that after that, so typically you see the inverted hammer at the bottom of a downtrend, and it has to be a white candle or a green candle. And the next day after, where you see this candle, is typically has to be a positive day. That way, that will confirm the signal so that you can get bullish and you can go long. So what's also the pointer here is that if you see a bullish inverted hammer, typically in the oversold area at the end of a downtrend, And if the stock opens positive the next day, the probability is more than 95% for that stock to keep moving up for a while. Now let's talk about bullish engulfing. So all this while we've been talking about single candlestick patterns. Now with bullish engulfing, you need two candles. Right? So this is one of the major signals. Again, it's a high probability reversal signal that is formed after a downtrend. As you can see, the white candle or the green candle opens below the previous day's close and closes above the previous day's open. So this bullish white candle or green candle engulfs the body of the previous candle, which is the black candle or the red candle. Not the shadows, but just the body. So this signal just shows that buyers are stepping in. Again, if you can add other indicators, say such as RSI, and if you can see if it is overbought, you can further your decision for reversal. And you can also layer in some of those T-line strategies that we talked about earlier. So as in the stock has to close above T-line, so you can go long and buy the stock. This is bullish engulfing, and bearish engulfing will be the same, but the down candle will engulf the up candle. It's just the opposite of this. But we won't be covering this here, but I'm just throwing that out there. Now, then there are a bunch of other signals like bullish harami, bearish harami, dark cloud cover, morning star, evening star, piercing patterns, so on and so forth. But the ones that I've listed and covered here are more than sufficient to step up your trading to the next level. Now also, if you're looking for stocks to trade, I will show you exactly how you can use stock charts or Finviz and even stock fetcher websites to pull up these stocks exhibiting these different patterns that you can trade, including both the candlesticks and the technical price action and other technical indicator based alerts. I'd call these predefined technical scans. Let's go through each of these websites first, and I'll show you where you can find these and then talk about some ideas about how you can trade some of these patterns.